I want to go through the math behind my study, Fibronacci, which draws these Fibonacci sequences, the retracements, automatically onto price action. So this is a 1 minute chart. This is a half hour. Let's change this to a 4 hour so we can kind of get a better sense of where it goes on a larger term. So you can kind of see this price action building in. So you have a peak here and a trough here, and this is the halfway point, as if you were to draw it right between. This is the same spot that you can see this line is being drawn by the same price action here. That's the 50% mark. So this is what the study looks like on the inside of it. So it's the hours is the look back. So this is how far back it's going to go, and this uses an aggregation period calculation here. So the aggregation period is just a function that you can use to say get the number of milliseconds that my chart period is. So it's, if you're in a 10-minute chart, it's the number of milliseconds in 10 minutes. We're in a 1 minute chart, so it's the number of milliseconds in 1 minute. But then what we're going to do is we're going to take that current chart range, divide it by 1,000, divided by 60. So we're getting into minutes now, right? So this is the one that's saying turn my current chart period into the number of microseconds in a minute, or into a number of minutes. And then we're going to multiply the hours. So it's 60 divided by, so this is an hour. So 60 divided by minutes is going to be 1 hour. So our hours is the multiplier. So if it's 4, we're multiplying it by 4 hours. So the range look back is going to be this many bars of look back. So this is a translation of hours. So 4 hours to a look back of however many bars, depending on what your current aggregation period is. So you want to make sure that so if it's 1 minute, then we're automatically determining how many bars that is in 10 minutes. That's all this calculation is doing. So then the next piece of this just determines whether we're using top or bottom of wicks or bodies, and that's kind of a question. Like the wicks often represent the extremes. So price may wick up above a certain level, but that doesn't mean that level has been overtaken, or that it's in any way indicative. It could just be a massive spike, but then value finds itself lower. So a lot of people believe that the bodies matter more in terms of finding value than the wicks, but it doesn't really matter. It ends up being more or less the same, just slightly different. I think bodies end up being slightly higher because there's slightly higher in a trending market up, slightly lower in a downtrending market. So the base calculation though is going to be based on this range of hours. So we're just going to go through real quick the what non-emulated does, and I can explain what the emulated does later. So the first thing we want to do is figure out whether or not the current bar we're on is a peak, and that just means whether it's the highest of the recent price action. So whether our current top is greater than or equal to the highest top and this is the highest of the past peak range. So however many bars that number of hours is. So that's our look back, and this is the whether or not we're greater than or equal to, and we actually could have just used top instead of top of the last bar, but I use the last bar because it takes the current bar out of the equation. So we don't necessarily worry about whether this is the top of the current peak. We ignore the current candle is basically what that means. And that's just to keep it stable while this candle is forming. So we're going to wait until this candle forms by using the last candle's version of it. And so the is trough is the same calculation, only the lowest. So we're going to find the lowest low over the last look back period. Peak range, again, being the last number of bars based on the hours that we input. So this is just going to be a yes or no. Is the top higher? Is the current top higher than the look back of all of the tops? So this is, yes if it is, and then or no if it's not. So yes or no. These are two yes or no questions. So then what we want to do is actually find the value of that peak number. So this is the yes or no question of, is this candle a peak or a trough? This is the, okay, well, what is the value of that peak or trough then, and how do we capture that going forward? So the first thing we ask is if it's not a number, and the reason it wouldn't be a number is because this top value is not a number, and if this top value is not a number, that means we're off the right side of price action. So what this is going to do is ask if it's not a number, that means that it's off to the right here, and if we want to continue drawing these off to the right, then we want to use the previous value of this rather than the current value. So if is peak is not a number, instead of a yes or no question, it's just woo, it's not, it's neither. It's not a number. So if is peak is not a number, then what we want to do is check if it's a peak, then we use top. So if it's not a number, this is a reversal card. So we're saying that it is a number. So we're in this price area. Then if it's a peak, if this candle is the highest, then we'll use the top value because we want the top. This is the peak. What's the value? We're trying to find the value of the top. But if it's not the peak, then we're going to use the previous peak. So this, in brackets, this is 1 bar back. If this were a 10, it'd be 10 bars back, but this is 1 bar back. So we're going to use yesterday, meaning the last bar peak, and so we're going to keep it. And so the else is just 2. This is an if statement, a full if statement. If is peak, then top, else peak 1. And you can just treat that as a single thing. You can put parentheses around it if it helps. But this is the outer one. If peak is not a number, then determine what the peak is. Otherwise, also use the last candle instead of trying to get a current value. So the only time we get a current value is if peak is a number and it's actually the peak. So if it is the peak, then we're going to record what the peak is. Otherwise, we're going to carry forward the last peak we found. And that's how you can draw lines off to the right side where there is no price action, is by testing whether or not what you're working with is a number or not. And then if it's not a number, just keep using the same one, because over here it's never going to change. So just keep using the one from the last one. And in the next candle, it'll just use the number that it's set for the one before that, and it'll just keep it going forever. So the way the calculation for the fibs is actually done is we're going to look. So now we've established a peak and we've established a trough value. So we know what for the look back period. Again, this is only for the last, however, let's say 4 hours. For the last 4 hours, we have a number that is the highest and the lowest. So that's the full range. So this full represents the peak minus the trough. So this is going to give us a value. And that's in dollars, right? So this is $4,282.50 here. That's the value that's going to be in it. So it's going to give us a value in dollars of that minus the bottom, which is going to give us the total dollar value of the peak to trough. And we'll use that for all of the calculations going forward, because that's going to be what we base everything on. So this is full, and sometimes we base it on halfway. That's the midpoint. But all of these Fibonacci numbers are well established from the Fibonacci sequence. So you have 1.618, and the numbers go on after that, but we don't care because the number of resolution we need on this is 1.618. Otherwise, it's like pi. I mean, it's 3.14159, and it keeps going, but you only need 3.14 to figure out most real-world applications. So we're only using 1.618, and for all of these numbers, whether it's the 23.6, the 38.2, these are all derived from the same series. We're only going to use the first tenths of a decimal point of the percentage, because that's more than enough accuracy. Any more accuracy than that, and we're just wasting processing time. So we don't really care. And we're turning this into a percentage anyway. So we turn that into 0.2236 for the 23.6 fib. So we can ignore this part because this is the emulation. I'll go back and explain that later. But just the basis of how to draw this, we have a value for the full amount of the peak to trough size, and the 0 is just going to be the trough. So if we'll ignore the not as in transition, all this is saying is just pay attention to the is not a number trough. So if it's not a number, which means it's off to the right hand side here, because we're no longer calculating trough from real numbers, so it just says, I'm sorry, I'm not a number. So if it's not a number, just use the previous value of the fib, the 0 fib. And again, the 1 is 1 bar back, so it's just going to use the previous value that it finds. But if it is a number, then use trough. So we're going to say the 0 at any given point, this fib 0 is going to equal the trough value. which we've determined up here, is the last look back period of that trough number. So 0, we're establishing a baseline here, is the lowest. So if trough has a number, we use it, and this is going to be whatever the last trough was. If trough is not a number, then we'll use the previous value just so we can keep drawing it off to the side for the future. Then what we do is we plot it. So this has to be a different name, so we plot fib 0, and this is what it looks like in the settings. You can see this as a tab, fib 0, so you want these to be as descriptive as possible. So we're just plotting fib 0 equals that value, that f0 value, and then we're just setting the painting strategy to horizontal so it doesn't draw a curve here. It doesn't try to draw a curve. I mean, I guess we could draw a curve, but this sort of emphasizes the fact that these are hard levels, and it's not a changing value usually, or the changing values don't matter. It's the stable levels that matter. So that's all that does by setting it horizontal. Then we're setting a default color. I have all my colors set as global, and the reason is because this lets you both lock down the color choices starting out, because I want these to be explanatory. Normally it'll just give you a bunch of random colors if you don't actually set any. And that's really irritating because I don't like going in and manually setting all. I want a default that works for me, and this is a good default. So this lets me make the 50% slightly larger or slightly brighter light blue. It lets me set these ones that, you know, the 23.6 is very dark. I hardly ever use these fibs myself. I don't think they're as useful for doing anything real. But and these ones are slightly brighter because they help me determine the scale of the move, and they often do hold within that range around the 50% as a good sort of gauge of whether this 50% is going to be respected this time through or not. And then the 100%, which is just the peak, I can color the same as the 0%, and then the extensions I can color various shades of purple, so slightly different. So once you define it as a global color, it lets the user change it later, but it also lets you reuse that same color over and over, so you can use it to both set the default color, which is going to be the default color for the study, which then forces the user to only set, they can't set whatever color they want for all of those things. We're telling it it's going to be the 0% color, but they can set the 0% color to whatever they want. And then later we assign value color, and that's the thing that forces it to be that 0%. So it's not just a default color, like this is what it'll look like if it draws it off to the right and doesn't recolor it yet. Normally that would be what the would be defined by the system, and this is defined by the user. But we're taking all of that control out of their hands, and we're just going to use our 0% color. So they can change the 0% color, but they can't change this fibs color by doing both of these. That's the reason I do both of them. Hide title and hide bubble is just because I don't like this bar cluttered up with all of those values, because I don't really need to know exactly what the number is. I just need to visually be able to see. Although for the 50%, I do set that as in my study manually as unhidden, because you still have control of this. You just have to go into the study and change it so that it doesn't hide the bubble. So that's the zero trough, and then when we start adding the fibs and the extensions, we're just going to take that same value. So it's instead of just the trough value, we're going to take the trough value because this is the 23.6. We're going to take the full, which is again the peak minus trough. So this is the height of the last peak to trough, and we're going to multiply it by 0.236, which is 23.6%. So we're going to say that full value times 23.6% is going to be, that's going to be our F23 value, which is what we plot our fib 23 from. And this is true of all of those levels. So we're taking, this is 38.2% of that full value. This is 50% of the value, but it's the same thing as dividing by 2. The 61.8%. And then when we get into the extensions, this is where the 161% is actually pretty interesting, because we're seeing this, now we're seeing this 618 number again. And you can plot other of these, like the 1.786, the 1.236. They're just not very well respected or very useful, because price is usually moving pretty fast past those areas. I mean, I'm sure it will get some confluence if price only sort of moves past and then comes back down, but as a probabilistic indicator of where you should be focusing your pricing efforts, it's not all that useful. But the positive and negative 168s are pretty important. They're worth drawing both of them on there automatically, above and below price action, so you can see where when that oscillation rubber bands back down, and if it keeps going through, that's where it might rubber band back up if it was an overcorrection. So this is kind of describing this extra low value below where the presumptive medium, that 50% is the presumptive value. This is all trying to find value as a moving target. It's a calculus designed to track where the current value is, not the current price, but how much this is oscillating around. It's oscillating around the value, but we keep throwing stones in the pond, so that value keeps changing. So this value keeps changing as well, depending on what the new peaks to troughs are. It's a range. It's always going to be a range, and depending on how many rocks we throw in, it's going to be a bigger or smaller range. But that's really it. I mean, that's what all it comes down to, is drawing these out by using the percentages that we're looking for. So 100% is just peak. So we just draw it at the peak. You could also do, a calculation to determine that. It would be trough plus full times 1, but we don't care. I mean, trough plus full times 0.618 is fine, but that's just extra calculation. You could just say peak, because we already have that number. We don't need to do a calculation to find out what the 100% is, because it's just 100%. That's our peak. So then, and the alert is really, really straightforward. We have a flag that lets the user decide whether they want to use an alert at all. But then what we do to alert, we're alerting on a sentiment change. So when our 50%, we can pick any of these, when any of these changes from the original, and I use the 50% because often peaks and troughs will change around a central value price. So the mid candle doesn't change, the range just gets smaller, because buyers and sellers are agreeing on that in principle as the price. They just, they've decided not to push the oscillations as far higher and lower, because it's starting to settle. The market's settling on that price. So when that mid candle changes, when the 50% level changes, that's a pretty good indicator that the value itself is in flux, and so that's why I want to change it. And then this is just another one of those if-thens. So if the current value is greater than the previous value, so that's that in brackets 1 means the previous candle, then we're going to print out the word higher, otherwise we'll print out the word lower. And then alert.bar is just there's 3 different things you can have here. You can either have bar, once, or tick. So this lets it alert once per bar, and then it'll stop. Or I think once at all is another option. And then sound.ding, there's a couple of built-in sounds that you want to use. I think the ding is fine for this. I don't think we need a opening bell or closing bell, but you could use that as the alarm if you wanted to. So that's just setting the alert. And all that does, again, is just draw the lines out for. It plots each one of these lines for the 100, the 0, and every one of these fibs in between, and then the extensions on the top and bottom. So that's how you draw them. It's really, really simple math. I mean, the math itself is just finding the last peak to trough, and then drawing that line in at a percentage of the full peak to trough movement. And that's it. That's really all that is. So the emulation part of it, the reason I did emulation is because what I wanted to do in here, and this is, you can see these values. If you emulate, actually this, I should move that up. This emulation is based on the old way of doing things, where it had to, the spike percent threshold is how far price action had to move, what percentage of the current peak to trough price action has to move before it will let you draw a new fib. And the reason I did it that way is because it cleaned up all of this junk in between, because price is obviously in flux in here. This is a useless time period to try and extrapolate some sort of value, because the price is actively moving through that value. So this is useless. So what this ends up doing then is it will smooth those lines out to a point where they just don't get drawn at all, apparently. Boy, that's really weird. Yeah, I guess that's just too far for 4 hours. Let's make it an hour. Actually, I think this might be my internet connection is not coming back with, because normally this would show a lot more variations. There we go. So you can see it draws it in. We just had to like find the price that actually worked with emulation. This is the other problem with emulation, is often it wouldn't show anything. But now we've got this price down to half an hour. So in a 1 minute chart, this is showing every half an hour of movement, which I don't know that that's all that useful, but I suppose it's good for figuring out local price action movements. But you can see it smoothed a lot of this out, and it just doesn't redraw it. And that's also, I mean, it's cool. It's just not necessarily as useful because it tries to make these areas a lot more stable. And you can see all the lines it's drawing. Here's all the fibs, and you can see them being respected. I mean, like they're definitely useful areas, but they're the way the emulation works is that it doesn't redraw until the local peak to trough over the last half hour has exceeded 25%. There's just not enough price movement in here for that. So it doesn't redraw it as fast. And when it does redraw it, that means that there's a lot of peaks, and then it finds this new movement. And you can kind of like play with it if you want to see the difference. You can just add more and make them the same value to see where it's drawing them. But obviously 4 hours is too much for this. And then one of the other things I like to do when I'm comparing these things is to take one of them and just make the 50% color radically different, so you can really see where those color differences are. So this is the relatively stable one. This is where it just keeps changing the value. It's more responsive, and this is why I wanted to do this, is like you can actually find these value areas within, and they're still important, so this the way this works is still trying to whatever. But you can see though that the 161s on this level this keeps it stable all the way through this price action, and you can see it break through, fail, retest under, break through again, retest and hold before moving up. So this is obviously a critical level, and it turns out this has confluence with ES from way back, which is pretty cool that this stuff ends up being that it's exactly 161% from a mid candle that started being drawn way back here. But that's just how emergent properties work. I mean, it's not magic, it's just math. It's just the algorithms that are governing this movement govern it in such a way that these 161 point levels work. So anyway, you can see the difference though, that it's not drawing a new one because we haven't had a spike like the look back period, which is changing pretty often here. We haven't had a spike within that look back period strong enough that beats that 0.25%. So that's a 25%. It has to be a quarter of that full move before it'll redraw. So you can actually make this a lot smaller. So if you make it like 0.1, for example, then it'll start redrawing a little bit more often. But obviously it's still not enough up here because this is on rails. That's a bad place to look at it. But down here you can see it moves a lot more, and there is a lot more actual, like it looks more or less like the emulator looks more like the old one as it moves around a lot more. The lower you set that, or the higher you set that spike percent threshold, the harder it will be to overcome it to draw a new fib line, and the more stable those fib lines will be, but the less useful they are. So the other thing that I changed in here was whether to use wicks or bodies. So let's stop the emulation and look for a second. So this is 0.5. So once you turn this off, this spike percent threshold no longer figures into the calculations. So now once we've turned it off, like you can see, this is the wicks versus body calculation. So you can see they're not that different. You can make your own determination of whether you would want to use it, but and here it's like they're almost the same. It looks like the wicks are slightly higher than the bodies, and it's just you're gonna have to play with it on however it is you're using it. I just wanted people to have the option to do that. But the way the emulation works, so now let's get into the actual emulate. If you pick yes, now we have a spike percent threshold, and the default is 25%. If you choose to emulate, so we're going to take our spike percent here and figure out what it needs to be. So this is going to be an ATR, and this is the one I used before, but I left this in here so you can see it's an exponential moving average of top minus bottom, which actually is full, right? So of full. So this is think of it as EMA of the full move over the last peak range. So whatever you pick this to be, say 4 hours. So this is going to be a 4-hour EMA of the value of the peak to trough. So it's the weighted average of peak to trough divided by the total full. So this is going to be how much the current peak to trough is bigger than the weighted average over the last range, and that's what that spike percent has to overcome. So that current peak to, it's not by per candle, but it often works that way. But it's what it's saying is the last peak amount of time of the peak to trough percentage of the current one. So if the current peak to trough is greater than the previous ones by at least, and here this is where the emulate is, at least that spike percent threshold. So it was 25% up there. So if our current spike percent on this moving average is greater than that 25%, then it'll say that it's in transition. And if it's in transition, it stops. This is a exclamation point is not. So if it's not in transition, right? So if it is in transition, then it's going to use the trough. And then it picks whatever the current trough is. So we're constantly reassessing what the peak and trough is on every single candle. This is just saying we won't do that unless it's in transition. And we only say it's in transition if that current peak to trough spike is higher than the threshold, like 25% of the EMA of that peak to trough. So it needs to be a move, is pretty much what this is saying, is that it has to move more than usual to be able to overcome this. And this is more or less how the old one worked. I left the link to the old one in my doc because there's a lot more settings in it that you can use. This is just emulating it because some people do like to just smooth out these, but it's nice to see the differences between them when you do, and how it affects the, what the price does. But this is true of so all of these are just using this in transition to either set it to trough or just use the old value and just keep it stable. And this is just saying don't let it flip unless there's a real move, something that's this ATR is average true range, where that average true range move is a pretty big percentage of what it has been in the past. And that's again, that the only reason is to keep those fibs more stable before being redrawn again. And that I think it's going to end up being a matter of personal preference, how you choose to use these things. But that's why I like to have this option, so that when a user goes in here and changes in their settings, whether they want to use wicks or bodies, or whether they want to emulate the way it worked because they want to smooth these out, all of those things will factor into how they want to use it. So giving them more options is always a good thing, so they can see, at this point price level started diverging from the mid candle, and it just kept going, and you can see the same thing both ways. It's just this is giving you a more exact version of events, like how long price remains stable between a peak and a trough. And this is literally showing you the pullback. As it pulls back, this becomes the new trough, and then as it moves up over that time period, that's how the price ends up moving, and that's why it moves the way it does. So anyway, I always think that giving people more options is better, except when it comes to how they use their colors. And that's mostly personal preference, because this is how I use it. And when I create a new one or reset, I actually go through and change all of these to be partially transparent, so they fade into my candles, so they don't override the candles. But I set them as the same value as those initial values, but then I'll just hit save as default, and now this is my default. So when I add it to another chart, the other thing I'll do is I'll change, the fib 0, I'll change to the short dash. Rather, this is the horizontal line, but this is a short dash horizontal line, and that's just to de-emphasize those. I'll do it for the 0 and the 100 to keep those, but the rest of them are the longer version of that. Sometimes I'll make the 50% bigger if it's if I'm using the study in a particular way, if I want to emphasize something. Having the bigger line can reinforce a more important range that you're looking for. You know, I mean, the look back period changes. It's basically like changing the fractal of the chart. So you know, having more options is better, but that look back period, again, it's just an input that we're using based on the current chart's aggregate range, which is going to be in minutes here. So we're on a 1 minute chart. This resolves to 1 because the current aggregate period divided by 1,000 divided by 60 on a 1 minute chart is going to equal 1. So now what we're doing is saying that's 1 bar. So this is our look back period again, based on, so our peak range is based on the number of hours we input, which could be 0.5, so that's a half an hour. And that's all part of this calculation. And that changes the fractal frame that you're in. So if you made this 4 hours, then it would be basically looking at a higher chart. With this is not necessarily going to show you good data unless you have a more peak to trough further back. Like this is not really, this is just saying this is the current peak to trough of this. But if we change this from 2 days to say 5 days, then we should see more movement kick in once it pulls in that data. But I'm not actually sure why it's not redrawing with the 4 hour. I think there's just not enough data on the chart. Or the 1 minute movement isn't being set up properly. I'll have to figure that out. So let's take a look at a different chart size. So like a 5 minute chart. And then you can see like this is smoothing it out more. And oh yeah, so that's why. It's because it was all the way down here. The value is just so far below before it finally managed to change all the way up here and draw a new one. But yeah, I mean, this is kind of neat to see how value is oscillating around this until there's a big enough move to change it, or until the peak to trough settles down in consolidation enough so that the look back period sees a smaller peak to trough. So when you have a bigger move out of it, then all of a sudden it doesn't take as much of a move to redraw the fib. So I don't know. Try it either way. But anyway, that's the math behind it. That's the Thinkscript behind it and how it plots and why I did it the way I did. Because if you have a stable, this is the emulator one, right? So if you have a nice stable one, you don't have all of this price action all over your chart. But you also can't zoom in and say, okay, well, where's the mid candle of this peak to trough? You know, like this is the bodies, right? So here's our peak, here's our trough, here's our mid candle. Like I can see where the mid candle is, and that's actually useful for me on the shorter term because now I can actually use that to make a decision that, you know, price action has come back up to the mid candle, and I want to enter here short and play a rejection and risk off of that. Or you could enter long, and if it breaks through, then you know you're still just risking your entry at that point. So you can play it either way depending on how you want to. But it's just a sort of a gauge to see where good entries might be. But you can't do that with the emulator mode. So there you have it. That's all the Thinkscript.